Hey guys, welcome back to Flow State Finance. My name's Arnav, and today I'm going to be talking about the income statement. Let's get started.
Alright, so today we're going to be talking about the income statement. In this video, we will first go over a basic definition of what an income statement is. Then we will explore its form and function. Then we will break down and analyze each component in a sample income statement. And finally, we will take a look at a real-world example of an income statement. So first, let's talk about the definition of an income statement. An income statement is one of three core financial documents that shows a company's profit and loss over a period of time. Now note that the phrase "over a period of time" is highlighted. The fact that this phrase is highlighted means that we have to address something very important before we continue with our exploration of the income statement. And that is the matching principle. The matching principle is a key principle in accounting that states the following. When recording a sale, the cost involved in delivering the product or service should be matched to the revenue generated as a result of those costs. Now that can sound a bit complicated, so let's break it down with an example. Let's say you own a coffee shop and buy $50 worth of beans at the start of the week. This amount of beans can make 100 cups of coffee, so your price per cup will be $50 of beans over 100 cups of coffee, or 50 cents for a cup of coffee. If you sold 20 cups in one day and you wanted to do the accounting for that day's sales, how much would you allocate as expenses for that day's coffee? Well, if you do the math, you'll realize that 20 cups in one day, with a cost of 50 cents per cup, will give you a cost of $10. So basically what this means is that when you're accounting for the cost of the beans that you've purchased, you're not going to count it as a $50 expense on your first day and then $0 of expenses on every subsequent day. Instead, you use the matching principle to match the cost of the beans that you paid to the actual revenue that you generated. So 20 cups times 50 cents a cup means you will account $10 worth of costs for that particular day's income statement. The matching principle is a way of distributing the cost of a big purchase so you have an accurate idea of just how much money you spent to generate the revenue that you did. Next, let's talk about the parts of an income statement. First, we have sales or revenue, and that is the amount of money earned in a specific time period. If you look at the income statement on the right, you can see that it is for the year ending on December 31st, 2012. So the $5 million in sales that company did were earned during that fiscal year, from December 31st, 2011 to December 31st, 2012. Next, we have expenses or costs. These are the costs incurred in generating the provided amount of revenue. So, in accordance with the matching principle that we discussed earlier, these costs are not all of the costs that the company has necessarily paid during that time period. They're just the costs that they incurred in generating the amount of revenue that they did. On the income statement, costs are broken down into two main categories. First, you have the cost of goods sold or cost of services category, which really depends on the nature of the business. A company that sells products will use cost of goods sold, whereas a company that delivers a service will use cost of services. And then the other category is operating expenses. You can think of these like fixed costs as they're not directly related to the production or delivery of the good or service. The next category on an income statement are taxes. Most notably is the income tax on the income earned during the time period. The income statement also has both pre- and post-tax figures, so you have an idea of how much the company paid in taxes during a particular time period. And finally, we have net income. This is the last and arguably most critical figure on an income statement. In order to get net income, you first add up all of the expenses, taxes, and depreciation that your company incurred over a particular time period. Then you subtract that figure from revenue, and that will give you your net income. Now, before we continue, let's go over some important terms that will help complete your understanding of the income statement. First, we have EBT, or earnings before taxes. The way you calculate EBT is gross revenue minus all expenses except taxes. Next, we have EBIT, or earnings before interest and taxes. EBIT is calculated by doing gross revenue minus all expenses except interest and taxes. And then we have EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Next, we have net income, which is EBT minus taxes. So you take the earnings before taxes, you subtract taxes, and that will give you your net income. This is also known as net profit. The terms are interchangeable. Next, we have interest expense. As you know, banks charge interest on money that you borrow from them, and that interest is put on the balance sheet as an interest expense. So if you see interest expense on a balance sheet, just know that that is the interest paid by a company on money owed to a bank. Finally, we have earnings per share, or EPS, and that is calculated by first doing net income minus dividends, and then dividing that figure by the weighted average of outstanding shares. Now, calculating EPS is complicated, so we won't get into it in this video, but just know that this is an important metric to consider when evaluating a company. Now, I'll be the first to admit that these terms can be a bit abstract and difficult to understand, so let's go over a diagram to help you visualize the components. Take a look at this diagram. It shows a comparison of the magnitude of the 5 following terms: EBT, EBIT, EBITDA, net income, and net profit. This diagram is not to scale in terms of what the actual magnitudes of these numbers are. So the numbers that you see, the 70, 60, 50, those numbers might actually differ in the real world. It's just there to help illustrate the magnitude of these numbers in comparison with each other. So first, if you look at the outer orange ring, you'll see EBITDA, which has a comparative value of 70. If you go one step in, you'll see EBIT, the blue ring, which has a comparative value of 60. So EBIT is less than EBITDA. Going in a step further, you'll see EBT, which is yet another 10 units smaller than EBIT. Going in another step, you'll see net income, which is the cyan ring. That is even smaller than EBT. And finally, you have the innermost ring of net profit, which, as you'll see in the diagram, is equal to net income, and that is because net income and net profit are interchangeable terms. So the key idea to gain from this diagram is that earnings are in the top line of every income statement. So the earnings before the most elements are taken out, so EBITDA is earnings before interest, taxes, depreciation, and amortization, are going to be higher than earnings before interest and taxes are taken out, which are going to be higher than earnings before just taxes. So as you take away more things from that top line revenue figure, the resulting value that you reach is going to get smaller and smaller. All right, now let's take a look at a sample. We'll be looking at the income statement of a fictional company, Company B, courtesy of Harvard Business School online. First things first, we can see that this income statement is for the year that ended on September 28th, 2019. So the information it contains is from September 28th, 2018 to September 28th, 2019. First, we have revenue. On this income statement, it says net sales, but net sales and revenue are the same thing. Revenue is a total amount of money generated from a company's business operations over a particular time period. So as we mentioned before, this income statement is for the fiscal year September 28th, 2018 to September 28th, 2019, which means that the revenue it shows is for that year. Next, we have cost of sales. This is also known as cost of goods sold or cost of services, but on this income statement, it's consolidated as cost of sales. These are the direct costs of selling the product, and remember, they're calculated in accordance with the matching principle. After net sales and cost of sales, we have gross profit. That can be found using the following formula: revenue minus cost of goods sold. That equals gross profit. Next, we have selling and operating expenses. Operating expenses are the other major category of costs. Think of them like fixed costs. They're also known as overhead. That might be a more common term that you're more familiar with. Underneath selling and operating expenses, we have general and administrative, or G&A, expenses. These are the administrative costs required to keep a company functioning. This is where all of the manager salaries and other administrative costs go. Adding up the operating expenses and G&A expenses will get you the total operating expenses. And if you subtract that figure from the gross profit, you'll get the operating income. This is the amount of money that a company makes before any interest or taxes are factored in. It's often considered to be EBIT, but there are a few differences. Most notably, EBIT includes non-operating expenses, in addition to the operating expenses, whereas operating income only factors in operating expenses. Here we can see the differentiation between operating income and EBIT. Operating income stops at the first red line. EBIT, on the other hand, also factors in other income, gain on financial instruments, and gain on foreign currency. While we don't have the exact value for EBIT in this income statement, we can certainly calculate it by ourselves. Take a look at the calculation on the right. We have our operating income of $765,000, to which we'll add $960 plus 5513 and subtract 12,649. That will give us an EBIT value of 759,000, or in this case, 759 million, because the income statement is in thousands. Below our EBIT line is the interest expense. This is the amount of money a company must pay on funds that it borrows. Just like you or your parents might be paying interest on a mortgage or a car loan, businesses must also pay interest on loans that they take out to fund their company. Next, we have income before taxes. This is also known as EBT, or pre-tax income. They all mean the same thing. And it's the earnings with all costs and income factored in except for taxes. If you take your EBT and subtract your income tax expense, you'll land on your net income, which is also known as net profit. It's the final and most important figure on an income statement because it tells you if the company is profitable or not.
Now, let's take a look at a sample income statement. There are many of them out there, but the one I've chosen for this video is Amazon. So what we have here is Amazon's consolidated statement of operations for the fiscal year ending on December 31st, 2017. Let's take a look at some important numbers on this statement. First, we have total net sales. In Amazon's case, they have both product and service sales, because as you may know, Amazon offers both products, like their Amazon Basics line, and services, like Amazon Prime Video and Amazon Music, so their income statement reflects that variety. Next, we have total operating expenses, which, if you'll remember, are presented in accordance with the matching principle. So this figure of $173,760 million, or around $174 billion, is the cost Amazon incurred to generate $177,866 million, or around $178 billion in sales. Next, in yellow, are the total non-operating expenses. Different companies may calculate this figure differently, and in Amazon's case, they've chosen to include interest-related expenses in their non-operating expenses category. Make sure when reading an income statement that you're aware of where information is located, so you have a good idea of what numbers contribute to the figure totals you see emphasized in each portion of the statement. After the non-operating expenses, we have Amazon's income taxes, which, if you'll recall, are what make up a significant portion of the taxes companies pay. Finally, we have net income, which is also net profit, and that's the important number, the bottom line that tells you if the company is profitable. In Amazon's case, their net income is around 3,000 million, or about $3 billion, so they are in fact a profitable company. As an additional note, we can see that this statement also contains some information about Amazon's EPS, or earnings per share, and the weighted average shares used in the calculation of that EPS. So those are the key ideas presented in any income statement. You have sales or revenue, operating expenses, interest expenses, and tax expenses. If you subtract the expenses from the revenue, you get net income, which tells you if a company is profitable. If you understand these ideas, you've understood the essence of the income statement.
That's all for today. If you learned something new, be sure to like, subscribe, and share this video with your friends. If you're interested in checking out some of the other finance topics I've covered on this channel, be sure to take a look at the description below. Thank you for learning with Flow State Finance.